Rule number 4, if you're looking at the market every day to see how you're doing, you're emotional. You're likely already emotionally compromised. And when the market goes up, you're happy. And when it goes down, you're sad. That's not a strategy. If emotion is a part of your strategy, you've already lost. You just don't know it yet.
Kris, there is a video that we've seen in a couple of YouTube videos where you found a freaking dead cat inside of a house. Was that part of the Detroit debacle?
No, dude, that wasn't specific to Detroit. That was more like, hey, here's a house that you can have at 93% discount, but by the way, it's going to come with hidden treasures. And I'm like, I wonder why this house is 93% off. And the moment I walked in the kitchen, I did not know genuinely that the dead cat was there.
Right.
And when I looked down, I freaking jumped back. Maggots had eaten this half carcass. It was so disgusting. And I'm like, oh, this makes a little bit more sense.
So I love learning from other people's mistakes.
Me too. Vicarious learning is the best.
It's the best. But Kris, I believe you've made some doozies over the years, right?
Dude, I don't know how anyone develops financial intelligence unless they do, make mistakes and trip and fall down. But most people don't get back up again.
Right.
Most people are making the kind of mistakes where they say, play it safe. And that is the biggest mistake of them all, is playing it safe.
So are you open to me kind of pulling some fun stories out of you today and talking about some of your big doozy
Dude,
mistakes?
We can talk about every mistake I've ever made completely openly, because there are not a few. And I'd like to think that the Midas touch that it appears that I've been having the last several years is a byproduct of having these mistakes, but then also learning from them. I always tell people, as an entrepreneur, your first decade is you doing everything wrong, because there's no real good school to teach you how to do it right.
Okay, so let's talk financial mistakes. You do everything from business to stocks to real estate, but let's start with real estate.
Okay.
What's your biggest real estate doozy?
Dude, the biggest mistake that I had made, I'm going to go back to my early days before I talk about my 7-figure screw ups. My biggest mistake was I had established this premise that I was buying single family homes below the median. And so I was basically buying homes at a discount, and I was scheduling 50 to 100K of profits on these small deals. It was very low maintenance. And while I held them, I had really, really good cash flow because I was doing lease options with them. I was getting basically double cash flow. And after maybe 25 homes, I had found this one home, and it was priced at $300,000 and it was worth $400,000. And I thought, this house has $100,000 of upfront equity. If I factor in the rest of my cash flow, I'm going to make a killing.
But it was outside your box.
It was outside my box. And I'm like,
oh,
there's a part of me that's like, Kris, don't do it. Don't do it. Because most of my real estate at that time I was buying was between like 160 and 220. The national median at the time was around 225, 240. And so I was really, for the most part, I was buying 20% below the median, because I knew when the market goes up, you're going to win. When the market goes down, you only lose if you bought above the median. That's where you start getting massive exposure, as in like 2008 hits and $1 million house is now worth $500,000. Because guess what? A house is only worth what someone's willing to pay. And when no one's willing to buy in that price range, you're screwed. And bottom line is, when you buy above the median, then like the bell curve for people below the median is really thick and chunky. Over the median, it is really slim pickings. There's way fewer people that want a $400,000 home than want a $180,000 home. So dude, I bought this house and I got it rented out, and my cash flow wasn't that hot, because there is this moment where cash flow is greatest before a certain point, and I was $60,000 past that point. So my cash flow was smaller comparative to the size of the deal. I didn't like that. Because it was bigger, I had a hard time actually renting it out. And it's because I was avoiding certain renovations, because on a house that size, the renovations were a lot more costly. It's more of a flip model, and I was doing a buy and hold. So it took months before I rented it out. When I did, my cash flow was really meager, but then the market took a turn.
Oh, this was right in 08.
And I got to tell you that $400,000 home, when it was worth $260 and I was $40,000 underwater, plus whatever I had put into it, plus my meager cash flow, it was in that moment I realized, I said, Kris, I love you, but don't you ever do that again.
You broke your rule.
And I have never broken that rule since.
And it bit you in the butt.
Yeah, because I learned that my strategy needs to work in up and down markets because I'm not a flipper. I am a generational wealth guy. Flipping is real estate as a job. It can make you really good money, but the moment you stop doing it, you stop earning, and I don't like that. I buy a home almost every single day of the week. It meets all of my rules. And when I sell that home, there's that $80,000 or $100,000 profit that I'm going to roll forward. I'm basically making 25, 30% a year. All the homes that I bought in the last 2 years, all of those homes right now, those ROIs are now triple from what they were before. And dude, I'm slaying it because I stayed in my lane. I stayed in the box. So it was a valuable experience, but it wasn't exactly my first blunder either. Dun, 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 the setup. I hear another bad deal coming out.
Yes. What's this other bad deal that you're referring to?
I did go to Detroit and Cleveland, Ohio,
Oh, yes.
and a couple homes in Wisconsin. And I bought from Fannie Mae after 2008. I bought 168 homes all at once on a tape from like as a ridiculous discount. It was a 93% discount. And I made this assumption. I can buy these homes, I can fix them up, I can rent them or flip them, and I'm going to make $10 million. 2 years later, I finally got rid of the very last house, and I only lost $1 million in the process. And I learned something about what's up, down, left, and right that I didn't understand in the game of real estate because that was my first experience going out of state. I got my butt handed to me.
Okay, talk to me a little about this. A tape. What does that mean? I've never heard that term before.
So banks, they have they are in the business of lending money. They are not in the real estate business.
Right.
They love to lend on real estate because it has a collateral component that makes them feel really safe and comfortable, and they understand the actuaries on default rates. But the moment there's a negative event in the economy, like a global financial crisis, a GFC, and a bunch of homes come back to the banks say, wait a second, my lending ratios, I can't lend money with all this negative debt because they'd get this cool fractional lending thing. You have $1 sitting in the bank. They're not lending $1. They can lend up to $100. But the moment their balance sheet is screwed up with a whole bunch of homes that have come back, their lending ratios are out the door. So their foreclosure process, they want to dump a home as fast as they can because they're not investor. They're not real estate minded. They just want to get rid of the bad debt. And so they have tapes, rolls where they'll bunch together a bunch of these homes. And at that time, the big mistake that I made is there were a lot of homes on the tape that I liked, but there was a lot that I didn't. And I thought the good ones will outweigh the bad ones. And so I decided to buy an entire roll of 180 plus homes. And one of my big lessons that I learned after that was buy homes one at a time and make sure that every home is a win. And that was another rule that I've applied every day since, thousands of homes later. And that led me to mastering the out-of-state game. And the second thing, though, that I really learned was that not all markets are created equal. Like, let me tell you something about Detroit. The mindset of entry-level slum housing. I was buying houses.
Were these slum housings?
These were in the worst parts of town. These were the first to go back to the bank. These were houses that I was buying for $7,000, $8,000, $9,000 a home that on the county records.
Not 90.
Not 90.
You were buying it for $9,000.
$9,000.
And you still couldn't turn a profit
And I still
off of
couldn't,
it?
but I'm going to explain why.
Holy crap.
So this is the math that I didn't understand. I didn't understand the market. And if you're going to go out of state, you have to understand the macro and the microeconomics. I've gone on to make so much money in out of state real estate that I don't own any real estate other than my own home in the market that I live in. I had Jason Derulo literally reach out to me. We were DMing each other. And then he said, well, Kris, do you have experience in LA? And I said, not only do I not have experience in LA, but I don't even buy homes in my own market. And then he called me up. He's like, okay, now you have to explain yourself. And I was teaching him some of these lessons, which is there are 324 markets and some are the best and most are the worst. And then there's a bunch in between. But I didn't know that. I started in the worst market because I thought I had a good deal. So here's what would happen. The county records would show a tax evaluation on the property between $80,000 and $120,000.
And you're thinking $9,000 for the home?
$9,000, how can I lose? Well, here's what I do. I'd put $25,000 into these absolutely wrecked homes. I was now $35,000, $40,000 into the home.
Which again, doesn't seem too crazy.
Doesn't seem too crazy. And guess what? They would not sell. One, because of that time in the market, but even renting them, because of the clientele, the type of renter that was attracted in the wrong part of town, all they could do was move in, skip rent for 90 days, and leave the house in piss poor condition again when they left. And so these things were costing me an arm and a leg, and then another arm and another leg. And I was walking around armless, just rolling around.
You're saying tenants would move in and legit not pay rent.
They were professional renters in this market. In other words, the city had created bylaws, something else I didn't understand, that would basically say you can move in, and if you don't pay rent for 90 days, these guys can't kick you out. So professional renters are the ones that know the rules, and they school you in the game. They exploit it. Yeah, so I didn't understand these things. And on that one, losing $1 million sucked, but honestly, that was almost nothing compared to the amount of money I've made because of the lessons I learned.
Of course.
But I got to tell you, a lot of people, when you have a mistake like that, I've seen what happens if you allow yourself to financially get wrecked. What I did is I got back up again. And I went to markets like Phoenix or in Vegas at the time, Orlando, that represented the best. And I started buying the right kind of home. These were relatively new homes. I was buying them for $90,000 to $120,000. They were previously $300,000 plus homes. And I knew that rebuild value was around $240,000, $250,000. So even though they were overpriced, I knew that I was buying them for less than half the cost to build. And the moment 5 years later, after I was done renting them, that the market caught up, I knew I was going to capture all that profit. We were making six figures on every single home while we had juicy cash flows along the way. And man, I've often wished if I could go back in time, Carson, 2008, I would just roll up my sleeves and do like 10,000, 20,000 more houses because I'd be so much wealthier than I am today. I did what I thought was good at the time, but I said to myself, I promise, here's the next lesson. When the iron is hot, strike fast and hard. And I didn't strike hard and fast enough, even though I did a few thousand deals. To other people are like, oh my gosh, that's amazing. How did you do so much? And I said, oh my gosh, I was playing so tiny. I should have done so much more. And I vowed when this happens again, I'll be ready. And guess what?
It's here.
It's happening again.
I know. So I gotta ask a question. 2 years ago, we were considering New Orleans.
Yeah.
And there were some juicy looking properties.
Yes.
Almost similar to what Detroit, I mean, not quite to that extreme.
Yep.
But did your experience in Detroit play into our ultimate decision?
I had a student that was doing some high pressure. The student had bought, first 6 or 8 homes, turned my head a little bit. They were making $600 to $1,000 cash flows. Then they did 20 of these deals and they said, Kris, come into this market. Let's do this together. And so I sent my acquisitions team and I said, give me a full write-up on the market. And they came back and they said, Kris, you do not want to own real estate in this market. I promise you it looks and smells and acts like Detroit. The numbers from this one investor did not look that way. A year later, I checked in again and this investor, I think, lost almost their entire portfolio, had gone belly up. And so you have to have the wisdom of 1, looking at the right numbers, and then 2, experience. I think one of the reasons why I have investors from all over the world that partner with me individually on all of my deals is because they know that I'm done licking my wounds and they know that I've risen up to go on and do thousands of deals profitably because I figured out the ways to not do it as well as the ways to do it.
Jeez. Holy cow.
Yeah.
Did it feel good buying 180 homes all at once though? There's got to be a bit of
the
pride.
In the moment, I thought this is big time and just the beginning.
Yeah.
I accidentally hit that button.
Whatever. It's a cha-ching moment. That was the knowledge drop.
Yeah. But what I really learned from it was worth so much more than honestly the 10 million that I could have made. Like, man, 324 markets, they are not all created equal. And if you can look at all the different components, look at the macroeconomics. I learned that you have to track not only population growth, which tells you something about supply and demand curve in that market, but migration. As in, are people moving here, or Detroit, are they moving out of here? You do not want to be in an economic winter market where the population is decreasing, because guess what? A house is only worth what someone's willing to pay. If there's more houses than there are people, that market's real estate price will drop. And that is happening right now globally. Japan for the last 40 years has been just bitten so hard by that in the real estate game, and they've needed to get awful creative. European countries right now are facing economic winter, and there are states inside the United States. It's not driven so much by population shifts. It's more about economies where you had the whole car industry that was there in Michigan and then pulled out and have just been massively decimated. They're now going overseas in many scenarios. So I learned to look at population and migration. I looked at job growth, wage growth. I started looking at the factors that really mattered. What companies, where are they moving? Where are they setting up huge headquarters? Where are they hiring like crazy? And where are we getting these influxes of migration and population growth? And wherever that happens, if you can also find the market where the median home price is lower than the national average, that might be a market that I'm interested in. But then when we come to wages, if you are in a market where the average income is 30,000 versus 60,000, I don't want to be in that market. I learned that when your average income is under 50,000, you pick up the type of tenant that if you're on the wrong side of town, they're going to beat the crap out of that property. It's part of their mentality and just the way that they are. But if you can do the opposite, if you go into a high growth area, a high demand area, and if you can go to an area where the incomes are 60,000 and greater, and you're on the right side of the tracks, guess what? In those markets, you can dominate and win and kill it. And those tenants, every 5 years, they don't do $10,000 or $20,000 worth of damage. All you're dealing with at time of sale is a little bit of lipstick on paint and carpet, which is very reasonable. And it's time to make that market, that property fresh and then sell it and then offload it. By the way, with a 1031 exchange or a cash out refinance so that you defer taxes as long as Biden will allow us to and doesn't rob us of those rights as well.
So a couple of weeks ago, we had a bunch of our partners out here and someone asked a question and your response was interesting. They were asking about a particular deal and your response was surprising. I think you said something like, you never look at one deal in isolation.
Yeah, there's so many people that are doing real estate in their backyard, Carson, and they're just saying, the real estate in my backyard is probably what I should be doing. And what they'll do is they won't look at the macroeconomics. They look at the microeconomics.
Yeah.
They look at the deal itself. Now you can always find one-off good deals in your backyard if you know what you're looking for. And that's a truth. But if you want to start playing the game at a higher level where you can predictably and consistently get the returns every single time, then you have to ask yourself, how do I take real estate and turn it into a conveyor belt machine? And that's what I've done. You see, if I go into the right markets, my ROI is nearly double. My ROI is literally double just because I've chosen a market that has all the macroeconomics lining up. Then I look at the microeconomics because I'm never interested in a deal. People reach out, Kris, would you invest in this deal? Kris, would you invest in this deal? And I look at them and I say, I love you, but if you can't show me 50 more, I'm not interested because all of my time, effort, and energy where I'm not an expert in this particular market, just for the sake of a deal, it's just too small of a game. It might be perfect for you, but at some point we got to grow up. At some point we got to play bigger games. And at some point we got to learn from mistakes and bring in deeper sophistication. And that's what this is. In this particular niche of real estate, I haven't learned anything new, Carson, for the last, 6, 7, 8 years because I figured it all out. I made all the mistakes. I learned everything. And all I've learned are tiny little tweaks to get my ROI a little higher from 25 to 26, 26% per annum to 28, 28 to 31 with optimizations here and there, tiny little improvements to how I do my bookkeeping and accounting and, how I twist the arm of property managers to care about me, just tiny little things.
Okay, so let's pivot away from real estate. What do you want to talk? You want to talk
Dude,
stocks,
let's talk about the
business?
top financial mistakes I see people making every single day.
This is great.
Across the board. Because I just came back, dude, I needed a little bit of a getaway, a little R&R, and no wife, no kids. I went with 3 of my buddies. We hit the mountains. We went out to my buddy's ranch in Idaho. It's a treed lot. I brought my Can-Am Mav X3. They brought their quads. And right now there's like 2 feet of snow on the ground. And otherwise there's a lot of green. And we were just having so much fun lighting it up, busting through these barriers and blockades of snow. It was crazy fun. I got stuck a number of times. We had to use winches to get ourselves out. It was a great time. And it was a great time to just say, hey, there's no self-service here. So anyone that wants to talk to me, I'm sorry, no dice. But one of my buddies brought something up. He said, yeah, I had invested in this one company and I won't name it because I don't want to upset anyone. But there was this company that he had done research on a little bit, but mostly trusted a friend. And the friend's hunch basically said, you're going to make a lot of money here. So he took a huge chunk of his portfolio and he dumped it in the hunch. Now, it ended up not going so well. And it's down about 20%. And he was emotional. He was just like, oh man, I'm so upset about this. And man, are there better options? Kris, what would you have done? And I said, well, John, it's his name. I said, you violated some of my private investing rules. So let me just take a moment and share some of them with you right now. Number 1, never invest on insider hunch information where you can't verify the research yourself. That smells of a get-rich-quick mindset that says, I trust my buddy and that's good enough for me. There's got to be data and there's got to be analytics behind it. And if there's not, it's a mistake. I said, here's your second mistake. You put in a huge amount of your available money into a single deal. Have you ever heard the adage, don't put all your eggs in one basket? And he said, well, yeah. I said, well, that's exactly what you did. And he's like, yeah, I guess you're right. I said, listen, If you want to find a hot pick, then you have to find 15. Wait, what? Yeah, if you find a hot pick, before you can invest in it, you got to find 15. Ray Dalio says that you should be in a minimum of 15 different stock picks, preferably in different industries, and all of them should have high asymmetric risk of super high return and very low downside. I mean, the worst downside is you lose everything, but it's not like, well, this company is looking at 20% annual gains, so if I lost everything in 5 years, I could also double my money in 5 years. That's not what I'm talking about. I'm talking about investing in a company that could corner a part of the market of the future. And I'm talking about 5G and 6G. I'm talking about who the next Tesla is. I'm talking about the next crypto. I'm talking about the companies that are going to make really big waves. These companies in telecommunication and robotics and AI and biomed, et cetera, if you can pick the company that has a 5,000 to 10,000% ROI and only put a 15th of your available money in there, then out of the 15, no matter how good of a pick you've got, you're going to lose more than half the time. In fact, you could lose 80% of the time. But if 20%, if 3 of your 15 picks end up doing a 5 to 10,000% ROI, you'll make all your money back and a whole lot more, which is why with that strategy, I'm averaging 3, 4, 5, 600% on average between all my win rates and lose rates. And so I said, rule number 2, don't put all your eggs in one basket, is you got to diversify, because you can't naively believe that you or your buddy or smart people with the analytics and data are going to win every single time, because they're not. And so those are just a couple of things that I shared with him, and they were valuable lessons. By the way, sometimes you got to fall on your financial nose and scrape it up a little bit before you actually humble yourself enough to say, what don't I know? Because the most dangerous information is what you don't. And when you act on your own information as if you do, unless you're an expert, you will get screwed. Mm-hmm. There's a high likelihood of loss if you're not an expert, which means the shortcut is always get with a financial ninja Jedi. Get with a financial genius. Get with someone that says, I've paid my stripes, I've done my Malcolm Gladwell 10,000 hours, and I've learned how to play that game. That's where I get my advice from. That's who I'm playing with. That's how I'm playing with. And right now, I just got to say I'm winning, and I'm happy at my win rate right now. But those are 2 pieces of advice that I see with people all the time that are just relying on, the market, because they'll put the money in 401ks and IRAs, dumb decisions like that earn single-digit ROI and guaranteed to get you nowhere by the time you get to retirement. And then with the little extra, they want to play in the market. And it's when you want to play that I'm like, hey, move away from single-digit stuff, move away from S&P 500. That will not be enough to get you where you want to go. If you want to do something really aggressive with high asymmetric risk, get an expert, get a philosophy, and then you stick to it. And if you do, rule number 3, never get emotional. If you're emotional, then on a down day, you're at risk for pulling your money out. And this particular strategy for me usually lends itself to 5 to 10 years with an annual rebalance, which means I am not, if you're looking, rule number 4, if you're looking at the market every day to see how you're doing, you're emotional. You're likely already emotionally compromised. And when the market goes up, you're happy. And when it goes down, you're sad. That's not a strategy. If emotion is a part of your strategy, you've already lost. You just don't know it yet.
Wow. Stocks. What else are you seeing people do that's a mistake out there?
I think there's a lot of people that are underrating cryptocurrency still. And the moment Elon Musk came in with his $1 billion tranche purchase, I think he sent a message to corporations. And we've now seen that not only is Tesla accepting Bitcoin for buying and selling product and Teslas, but we're seeing all sorts of banks, financial institutions come on board, and they're now investing in, here's 25 million, here's 250 million, here's a $500 million. Massive investment is now going in that coin. And, the reality is that coin is going to keep on going up. And, there's a number of altcoins that I make tons of money on, but I rely on financial services, data services, and analytics to help me make short-term moves, 1, 2, 3 month moves, where I'm averaging right now. I'm doing right now anywhere from 50 to 100% a month on some of my money that I'm investing. But guess what? The returns are good. Ask me what percentage of my money I put in there. Money I can afford to lose. Mm-hmm. In other words, it's not 50% of my net worth. It's not 80%. It's not even 10%. This high growth or high risk go to zero stuff, if you want to be non-emotional about it, then you got to put the right amount of money in. So I'd say that's a 5th rule, which is a mistake I see people making, is they're putting too much in that creates an emotional response. And instead, you've got to put enough in so it's really just to set it and to forget it. And my rule of thumb, it's got to be money you can afford to lose. because most of my strategy in that market is I only need a handful of wins to become rich. And I'm okay actually losing more often than half the time. And I can't be emotional every time I lose.
So you got into crypto, what, 4 years ago?
Yeah.
And any rookie mistakes when you first got that?
Yeah, my first rookie mistake was just trusting people. I heard this. My buddy gave me a hunch. If you want to throw some money at hunch,
didn't pan out?
If you want hunch money, well, I'm not going to say it didn't pan out because honestly, some of them did, but some of them didn't. And that's the point, is that hunches, that's like rolling the dice. That's like going to Vegas and putting it all on red or black. And there's way too much of a luck component. We're talking about intelligent risk. And that kind of risk means that you've crunched the numbers and you know your odds and you've learned how to beat the odds. And if you don't have a strategy for beating the odds in one way, shape, or form, then it's a dumb game that you're playing.
So I know there was a situation with one of your wallets recently that you've got a few Bitcoins tied up, right?
Well, I had several Bitcoin, and my wallet, was stolen. I mean, it was Cryptopia out of New Zealand, and basically they were compromised. And this is about a year ago, and everyone has come in now, and they've got the feds involved, and people are trying to figure out how to recapture people's whatevers. And I'm looking at that, and I'm like, okay, what mistake did I make? Well, I held my money in. It would almost be like if Coinbase got hacked and got shut down, and they had to redistribute everyone's money minus all the fees for trying to figure it all out, kind of thing. And I chalked that one up mostly to bad luck. I'm not sure I did anything wrong, because that was one of the largest crypto holders and agencies at the time that was allowing you to transact your coins.
Well, and it's interesting because when you first start talking to people about crypto, the big thing that people tell you is crypto is so safe, it's unhackable.
Yeah,
but what people don't understand is that's the blockchain. That doesn't mean your wallet can't be hacked.
Yeah.
And for those who don't know, what's one Bitcoin worth right now, Kris?
This morning, 59,000.
59,000. So when you had like what, 2 or 3 Bitcoin?
I had 10. Yeah.
You had 10?
What is that? $500,000, 600,000. Yeah.
Holy crap.
But by the way, your response is an emotional response that amount of money is large.
Because it is. If you find those Bitcoins and don't want them anymore,
you'll take them?
I'll take them off your hands.
I've offered a little fee to someone on my team. I'm like, hey, here's what I'll pay if you help me recover these.
Yeah.
My buddy did tell me, by the way, neat little tip. They said, if you lose your wallet or if your wallet is hacked or stolen, there's now IRS precedents established since 2017 that cryptocurrency is classified as property. And so you know how, so I'm actually making a claim against my insurance company, my homeowner's insurance, and there's a good chance I'll recover it that way. So I'm cultivating a couple of angles to be responsible, but at the end of the game, at the end of the day, a person has to realize that money is a game, and the game isn't to win. Warren Buffett is smart when he says, don't lose money. That's rule number 1. In other words, he's saying, be as careful and smart and intelligent as you can. But you have to balance that with reality that, listen, I've got my money diversified in dozens of different places across multiple different channels and platforms across several different industries. People are like, oh, Kris, you're the real estate guy. I'm like, yeah, on the outside, that's where I give a lot of my advice and training and help people build incredible sums of wealth. But at the end of the day, that is one asset class. And my new book coming out, which is called Have It All. It's named after the show right here. It teaches the core 5 investments that are 5 alternative investments that everyone should be involved in minimally on your road to 10, 15 plus different, Dalio's the one that basically says once you achieve 15 different asset classes, that's when you'll achieve 85% safety. Because in your lifetime, every asset class is going to lose the majority of its value. It may come back, but it's all about keeping yourself properly protected.
Kris, so let's pivot a little bit here. Let's talk business, because business, I think, is the most complex game there is. Other than when you were selling sugar.
Yeah, when I almost went to jail. In middle school, Kris Krohn got caught with drugs. It was just sugar.
It was straight up, he was selling colored sugar.
I was selling Fun Dip. I came up with my own homemade Fun Dip, and it was $2 for the small packs, and it was $4 for the big packs, and it was colored. It didn't even look like drugs. I didn't even know what drugs were in the 8th grade. And
you didn't know
when my vice principal,
why a little baggie with powder?
She confiscated my shoulder bag, my messenger bag that had,
a bunch of sugar in it.
I had already made $60 that day. She took one of the bags out, she dipped her pinky in it, and then she sniffed it. And I'm like, what are you doing? You put it on your tongue. And yeah, she was testing it.
She was
testing the product.
So funny. So besides that, what was your first real business?
For me, it was actually being a paper boy. It took an hour a day. I was also the shack manager. As I got promoted, I picked up 3 routes, and I was making about $600 a month. And,
what age?
Huh?
How old were you?
I was 15.
That's not bad for a 15-year-old.
No, I mean, I saved up, by the time I finished high school, I saved up 10 grand, had 10 grand sitting in the bank. And my dad always said, and by the way, this is another lesson. It's not just business, but it's actually just financial sense that is not common because it's not trained. It's about budgeting. My dad said, okay, Kris, I cover more or less all your expenses, but now you have this job. So you're going to pay for your clothes once a year at the start of the new year. When you want to go shopping, you're in charge of your own clothes. So he said, here's what I want you to do. I want you to give 10% to charity. At the time, that was mostly just giving it to my church, but giving 10% to charity, that money would get used to help people. That was the first thing he said. And then he said, then I want you to put 20% in your checking account, and this money needs to be used for whatever the heck you want, but it's got to be enough for clothes at the start of the year. And then he says, the other 70% just go straight into savings. So the $10,000 I had saved up in savings.
Was that 70% building up?
Was that 70% building up? And my dad taught me something really important, but as an adult, here's what became even more important. The principle that I think he was attempting to teach me is called pay yourself first. We're taught to pay our bills first. Like, I am working to live. I'm working to pay my obligations. That is a great way to stay poor, but feel like you're living it up, maybe even keeping up with the Joneses, which means you could be making $40,000 a year and spending plus or minus 10% of $40,000 a year, winding up with very little to nothing left in savings at the end of the year. But you could also make $400,000 a year and be guilty of the exact same ratios. And so one of the things that my dad taught me was you have to be a saver if you want to invest and get anything done. And so, today, here right now on this podcast, one of the things that I want everybody to know is how much should you be saving? There's 2 figures I'm going to throw out. The first one feels obscene. The second one is far more obscene. The first one is you should save and pay yourself first 20% of what you make. Which means if you make $50,000 a year, there's got to be 10 grand in savings left over at the end of the year for investing. It's not for savings. It's not for a sleep well at night account. It's not for peace of mind. Part of it is, it's so that the only way to become wealthy is through investing. It's not by working at a job. You got to be smart with the money that you earn, right? You might be working at a job for 40 years. It might be 4 years. And it might be even less than that if you can follow this one rule. And by the way, if your finances are not organized as such that you're saving 20%, then you are violating this rule of the wealthy, and that means that you love consuming more than you love investing. And I'm going to put it in those frank terms. You love consuming more than investing, and you have to switch your mindset and say, I would rather delay gratification and become an investor than I would consume it. Because the whole purpose is to get your money working for you, and that only works if you have money to invest. So if you want money to work for you and in time become more and more and more and more, you got to be a really good saver. And rather a saver and an investor. But the second more obscene rule, Carson, I actually tell people, I say, and if you want to be wealthy in your lifetime, not at retirement, in your working years, then you actually have to find a way to save $50,000 a year. And most people say, Kris, even if I make $100,000 a year, which means it's way better than the average, maybe I'm making $50,000, which is average American earnings, and me and my spouse or partner we're combined at 100. How on earth do you expect us to save 50? Yes, that is the problem I do want you to solve for. I want you to actually ask yourself. And by the way, that $50,000 bill is more important than your house payment. It's more important than your cell phone. It's more important than your car payment. Those things can be repossessed, but your life is being hijacked and repossessed every day that you're not putting $50,000 a year aside. $50,000 a year is enough for you to buy an investment property that can provide meaningful cash flow and grow with time and create wealth. $50,000 is enough to start a franchise, a meaningful business, or figure something out or do a license agreement for making money. $50,000 is enough to have some money to lose, to dabble, to try, to be in the game. You only get in the game if you have money to play with, and the only way you get it, 20% of whatever your income, if it's not 50 grand. By the way, 20% of $250,000 a year is 50,000. So there's a high likelihood that you do not make $250,000 a year, nor have the ability to save 20%. And here's what my message is. Figure it out. Get creative. Wrestle mentally with opportunity day in and day out until you find a way to save an extra $50,000 a year. Because I promise you something. Got good news for you. If you make $50,000 a year, as the average American does, your company hopes to get a 400% ROI on you. That means they hope to bring in $200,000 of revenue because you're not a person, you're also an asset. And as an asset, they expect a return on their investment. So they pay you 50 of the 200 that they make off of you. If they can do that, why can't you? If they can do that, and by the way, if you give them 8 hours a day and they make 4 times as much money, then you should be able to make the same amount of money in a fourth of the time. I'm not going to go into the math, but the bottom line is 2 hours a day, $50,000 a year. Do the math, figure it out. What side hustle, what could you do? How could you leverage yourself a couple extra hours a day? And by the way, am I saying that you should have a period of time in your life where you strap down and cowboy up and work extra hard and put in more time and effort and rob yourself valuable life memories or time in front of the boob tube or watching some Netflix or seeing some of your kids' game? Am I saying that for a period of time in your life, that unless you're saving an extra $50,000 a year, that you should be foregoing and sacrificing some of those things? Yeah, that's exactly what I'm saying. I think everyone, when you hit the reality check, unless you want bump in the night to get worse each and every year that you live, you got to get smart. And I'm telling you right now, this is the advice that I wish I had gotten. Fortunately, I got it in a different way. And that's why I was financially free by the age of 26, because I found a way to, at first, save an extra $5,000 a year. Then it turned into 15, then it turned into 50, then it turned into 6 figures. And it's because of this one thing. I fell in love with investing more than consuming. And it meant that a time came when I could consume anything I've ever wanted. That's what my lifestyle's been like for the last, way beyond a decade. And that's because I had a period of time in my life when investing was the only priority. And I did make some sacrifices. There was a time when I was a full-time student. I worked full-time. And then I also was married and I was doing my business on the side. And I could have pulled my hair out for what I put myself through for those 4 years. But you know what? It set me up for life. So I'm not necessarily saying work yourself to death. I am saying that your strategy shouldn't be to do that for a decade either. I'm saying that you should evaluate opportunities that have high likelihood, low risk, and potential of solving this problem in a matter of a few short years to set you up for an incredible life. This is what successful people do.
Kris, I said a little bit ago that I believe business is the toughest game out there just because there's so many moving parts and there's so many ways to do it wrong.
I think it's the toughest game if you're new to it. I think when you get good at it, it's fun and it's easy.
Yes, and it also takes a certain level of motivation and a true entrepreneur to be willing to learn the painful lessons that come with business. So I want to know, what are some of your rookie mistakes when it comes to business?
I'm so glad that we're just dedicating an entire episode to all of my mistakes. So let me share.
I prefaced all of this,
it's good.
Kris.
Let me share with you some of the things that I did that were really stupid. In the beginning, I thought I had a company when it was really a hobby, and I gave equity out like it was candy. And like the benefit that created lasted for a mere second.
So how did that work out? When you say give away equity, are you like being like, hey, I'm going to give you a percentage
I'm like,
of the company?
You're doing something important. Here's 15% of the company. I like you. Here's 10% of the company. Hey, thanks for showing up. Here's 20%.
Was it part of the motivation to get them to come work?
Well, I didn't understand the difference between an equity owner is someone that owns the company. They are the visionary, the strategist, or their team and their employees aren't necessarily owners. That doesn't mean you shouldn't give stock away to help motivate them or create incentive packages. But I was cavalier and I was lawless. And as a result, that company didn't survive. The equity didn't survive. The ownership didn't survive. So by the way, anytime you do something in business that is designed to create a benefit and it doesn't work, it means you created a disincentive. And it's very easy to have good intentions and have them actually turn into bad results. Like another example, I really like this one employee I was working with. She was my bookkeeper. And I was like, wow, she's doing so good. I should give her more responsibility and promote her. Sounds pretty harmless. But I promoted her too quick and too fast. And after a very short period of time, I found out that some of the dollars that belonged to me in my company had somehow like managed to go in her pocket. And
whoops.
Yeah. So by the way, I also learned something about trusting the wrong people, but then I doubled down on another horrible mistake. I felt vindictive, I felt wronged, and I felt betrayed. So you know what I did? I sat this individual down. I printed out my 5 inches of proof against them, and I started reading off page by page my evidence. And I didn't get past the second page before the person ran out crying. And needless to say, because of how I handled it, because I was angry and frustrated, that they retaliated, even though they were in the wrong. And their retaliation ended up in a legal matter that cost me $1 million.
Well, and we say this phrase a lot in business, Kris. It really doesn't matter who's right and wrong. All that really matters is what a person can do and what a person can't. I mean, we call that the Jack Sparrow wisdom, right? Because at the end of the day, even though she was wrong, what was she capable of doing?
A lot of mayhem.
Yeah,
she was a wounded animal in the corner. She decided to bite the hand that had been feeding her.
Did the drama stop?
No, it didn't. It went on for a year and a half. And then for another 4 years after with just bad press and bad media about it. So I those were some sucker punches, maybe in the long run, like some really inexpensive lessons, but they were painful. When you become an entrepreneur and a business owner, you're creating a world, a culture. You're igniting and pulling together a group of people. You're creating excitement around a product or a service that need to be led by vision, but you also need your oracles that can manage the numbers and the spreadsheets. And there's so many moving pieces. So you're right. It is one of the hardest games to learn, but only by playing it and maybe making mistakes and learning from them and surviving them do you get good at the game. And some of the biggest, most financially successful people we look up to are people that in their early days made mistakes and then muddled through them and then figured out and then became really wildly successful. So, man, do I wish we had a university that just taught business so that you could skip all these mistakes? Well, dude, that's one of the reasons why I have all my social media out there. I'm trying to rapidly educate as many people as possible on basically saying, hey, learn from my mistakes and then do it smarter and better.
Okay, partnerships is an area that I feel like people have a lot of interesting feelings about partnerships, like Dave Ramsey. Never partner with people, never go in it together. What are your thoughts on
I think that you need to understand the difference between equity, revenue share, and profit share. I think most partnerships I've ever created actually revolve around these 3 ideas.
Okay.
Equity is something I'm very, very stingy with because it doesn't necessarily pay you money. If the company's profitable, then your percentage of ownership on distribution will be money to you. But I've learned that you have to find out, are they interested in the long run ownership game or are they interested in getting a piece of the action? If they want a piece of the action, then you move to a revenue share. Hey, a percentage of the revenue you're going to get in lieu of ownership. And that means that they get paid no matter what. But there's also a profit share model because revenue means the moment a dollar comes in, I'm taxed on it by our agreement and I'm going to give you a piece of it. But if it's a profit share, then it means, wait a second, after all expenses have been paid, then there's leftover money and then you get a piece of that. That's my favorite model because what it really says is I'm incentivizing you to grow the company financially lean without having, unnecessary expenses because that's gonna tax you. But if you're really good at widening the profit margin, let me give you a piece of what's kept at the end of the day. And so over the years, I've gone from a partnership model of equity into a partnership model of revenue, and finally to profit margin and a profit share. And profit share has been my favorite form of incentivization because now I'm incentivizing all the right behaviors. Not just can you produce revenue, but can you also manage the expenses to keep the biggest gap possible? I'd rather give someone a higher percentage of profits rather than a lower percentage of revenue because I'm incentivizing them to be accountable to all financial choices, not just money that comes in the company.
Kris, is there ever a partnership that went south or someone that maybe in hindsight, do you wish you hadn't have partnered with them? Were there red flags? Like, have you ever experienced anything like that?
I have found that almost, outside of I'll put it to you this way. When you know every part of a business, partnerships are beautiful. When the majority of the business has unknowns, partnerships have backfired on me. And what I mean is, I'll give you 2 examples. When I look at my real estate business, I have learned everything there is to know about that.
Of course.
I treat those as true partnerships, equity and all. And so I'll put up my team and my effort, my resources and the deals and do all the work. They'll bring the money in and we'll be 50-50. We'll split all the profits equally.
Well, and it's because like you said, you have all the unknowns on real estate.
They're all knowns
exactly
now.
How exactly everything's going to play out.
100%. However, when you're putting a brand new business together and you don't know what you don't know, that information, I mean, you don't know if your universe is going to expand 1,000-fold and everything behind it. It's kind of like, I date and married my woman, Klen, after like 10 months of knowing her. And I didn't realize at the time that I was saying yes to everything I didn't know about her. And the next several years, I learned all sorts of things I didn't know about her, and we worked through it. And now we're celebrating. Today is actually, May 3rd is the 20th anniversary from the day we met.
Really?
Yeah. And I'm like, today we're celebrating like Cloud 10, that almost every day is literally heavenly, no matter what's happening in the world. We have formed such an amazing bond. That's a partnership I'm so grateful for. That's like an exception to the rule in business for me, however. And the reason why is because most business partnerships don't feel fair unless there's equal equity, like a 50-50. And the moment it's 50-50, you have to ask, are equitable or equal contributions being made? And I find that in almost every situation, the answer is no. So personally, privately, just me, if I find someone valuable to the company, I'd rather say, you produce, you get to keep some of the profit on what you kill. And that way it's like, I don't have to compare you to me. I don't have to compare whether I'm going to outpace you or outdo you. It's make whatever contribution you can. And the reality is we are bad guessers of what a person's contribution in the end usually is. It's usually a lot bigger, a lot smaller, but it's rarely dead on. And so it's just not fair. And that's why partnerships don't work. It's not skepticism. It's not history. It's that when you have too many unknowns, it's more fair to give people what you can control, which is a piece of the action, rather than guessing this year we will do X amount of profit. And I'm assuming you'll show up in this way and I'll show up in that way and everything will be hunky dory. And it just doesn't go down that way.
Well, and I think one of the things about equity is when a business is just starting and you don't have revenue, you feel like that's something you can give without it affecting the P&L sheet, the bottom line of the company. It's like I can incentivize this person essentially without paying them today.
And there's an exception to every rule of why that's a good idea too.
Yeah.
Right? I'm just giving in general a rule of thumb, but there will be exceptions for sure. But knowing how to do that the right way, those are the lessons that I've messed up on.
Okay, let's pivot one more time and let's talk employees.
Have it all. Here we come. Employees.
Yes.
I've been an employee, by the way.
Yes, and I want to know.
When I was in college, I was an employee for 4.5 years before I was financially free, and then I dodged that bullet and was done.
So there's a significant number of people out there who maybe aren't as interested in being a business owner.
Yeah.
They're more of an entrepreneur. They want to be good at the job they're pursuing.
Yes.
What are some rookie mistakes you've seen either in you or in people we've hired?
Yep. There are 3 types of people. There's business owners, there are entrepreneurs, you have intrapreneurs, and you have employees. And I want to define all 3 of these. We already know who the entrepreneur is. An intrapreneur is someone that takes a personal interest in the growth of the company, like an entrepreneur, but they don't have to carry the debt burdens or the financial stress, and they can be rewarded by the company for helping expand and grow its vision. That's who you want to hire. Then you have an employee. And an employee is someone that frankly says, I'm a paycheck and I really just don't care. I don't really want to necessarily improve. And if you collect too many of those, then you're going to have a lawless culture and you're going to have drama and you're going to have frustrations, which means if you are a business owner, then you've got to figure out how do I help everyone be an entrepreneur, which means an employee that gets a piece of the action that cares. There's a couple things that you do. Number 1, you create a culture that has rules of who we are and who we're not. Like, for example, I don't do drama and I don't do passive aggressive, and there's a bunch of other rules. But number 2, I'm also finding a way to give you a piece of the action. I've found that if you can take a member of the team that is there because they care about the company's growth and vision and finds a way to get a bonus or a piece of the action, that person is an intrapreneur that's helping you grow and expand your company. If you have too many members of your team that don't have those incentives put in place, then you're going to have more of a culture that is driven by whoever they are. And a cultureless company has all sorts of drama and problems. So that's one of my lessons, is that you have to have a culture. Frankly, I hired you as my CEO because I knew you were going to bring a culture that would care about every hire and help bring intrapreneurs into the game that could care about the results, that could care about being results oriented. And that's been a really important factor in what we do here.
So Kris, what about you? When you first started working as an employee, what type of employee were you?
So in the beginning, I was first of all hired on to do a 100% commission gig. I had never done that before, but I was highly motivated because financially I didn't have any money. And To be honest, it was a struggle for me. I spent several months trying to figure out how to play that game. But frankly, I found out just by my own motivation how to be at least average or maybe sometimes a little above average. When I came up on a year in the company, many people wouldn't survive that 1 year mark. And because I was still there, I made a move. I asked if I could also contribute to training the sales team and give me a little bit of a base wage. And they agreed to $500 a week. So $2,000 a month, which by the way, not a lot of money, but that plus the commissions started adding up to something. And it took me about 2 years before I developed a strategy, as a one that I think every employee should have, every entrepreneur needs to have, which is you should, number one, make sure you're doing your job really well, that you are exceeding expectations from the company. You should know what are the drivers, what do they care about, what are the metrics, and then you should be hitting them. But then you got to figure out how to hit them well enough to make room for something new. I always tell everyone, you should figure out with your skill sets, where is an area in the company where they could be making more money and they're not, that you think you could fill the gap on. And after 2 years of doing this, I found such a spot and I went to the company and I said, hey, as an experiment, I'd like to build a little team over here that can focus on these small product sales. And I think that we might be able to do $20,000 or $30,000 a week. Would that be meaningful to you? And they said, yes, but I don't have a proven track record. So I know they wouldn't feel comfortable paying me to do that. So I said, you know what? With your permission, I would just like for 6 months to screw around, see if I can make you guys some money. Can I do that? And you know what they said? As long as you meet your other expectations and critical drivers, et cetera, sure. Well, over the 6 months, I built up a team that was creating an extra $50,000 of weekly revenue for the company. And I did the math and I'm like, all right, so this is a few $1 million a year to the company. And after 6 months, I said, hey guys, how's that thing going? They're like, oh man, we're so appreciative. It's turned out better than we thought it would, better than you pitched us. And I said, you know what? Can I have an X% override? It was small, it's like 1 or 2%. Can I have an override on what that team produces now that I've spent 6 months building it? You know what they said? Sure, because guess what I had?
Track record.
I had track record. So, but at the same time, I said, you know what? There's this other thing that I think the company might be missing out on. Do you mind if I dabble and mess around and see if I can produce some revenue with that? They said, sure. 6 months later, I had built this revenue stream for the company. I said, how's that going? They're like, oh man, Kris, this is so meaningful. This is amazing. Thank you for having done that. I said, you know what? I would love to continue growing it and pushing its limits and making as much money for the company as possible. Will you give me this 1 or 2%, override? And they said, yes. Well, after doing this 3 or 4 times, my income had grown from my first year less than $20,000 a year. My income was now $134,000 in a year. And fortunately, my real estate on the side was even making me more money than that. But it's because I didn't just settle for the job they gave me. Mm-hmm. I said, I'm going to take this opportunity and make it even better than you think it is. And so I decided to make myself the most valuable player that I possibly was capable of. And I understood the goals of the company and I found a way to exceed expectations. And I think everyone should do that. I don't think that you should just show up at a job and do your 9 to 5 and check the boxes and then receive your paycheck. I think that in life, whatever isn't growing is dying. I think that's a method. And I like that idea is going to, over time, decrease passion, decrease drive, and make your job feel like a job. Just this thing that you put in and that you slave at. If you want to make your job exciting, then ask yourself, where can I help the company get more revenue? How can I get permission to affect it? And then after I've proven it, if you can, then ask for a piece of the action. I give myself my own raises. I always tell people, give yourself a raise. Don't just do a raise based on meeting their expectations. Exceed them and then ask to create something that they don't see or have time, effort, energy, or bandwidth for, and then see what you can build there. That's how you rise the corporate ladder as fast as possible. It's not by exceeding their expectations. It's by going beyond their expectations. And that's something that everyone should implement.
Kris, I really appreciate you being willing to get vulnerable and share with us some of your mistakes. I love learning from other people's mistakes because it means I don't have to walk that same painful road. And one of the best ways that we can all learn from people's mistakes is books, man. I mean, how often are you reading a book?
All the time. I'm always reading a book.
Because, and it enables you without having that proximity to someone to take all their lessons and just, suck it out of their head and download it.
Dude, if I can read a book a week and walk away with 2 ideas that I didn't have before, then you start compounding that impact over time and you're going to become an extraordinary person with extraordinary results.
Well, and you as an individual has also sought to get the word out there about things that you've learned and share your ideas. And of course, you produce several books. We try and give them away for free so that people can get this information, just hit up kriskrohn.com/podcast free book. And you can go there, and that is a really great place for people to get started in real estate, of all things, and some ways to do it without coming out of pocket too much. Learn from the mistakes that Kris made in the beginning that got him, over those mistakes and having success sooner rather than later.
Yeah, totally agree, guys. The books are free. Go and grab them. All the books that I've written, there's a way for you to access them. So be sure to do that. I would just say that today, what I'm most excited about is we are doing what's called vicarious learning. My professor in college said, you don't want to have to stick your head in a garbage can to find out that it stinks. And, classic example, might seeing someone overdose on drugs. When that happened to me and I witnessed that, I learned something that day. That's never going to be me. I'm going to make life choices where that is an outcome that is impossible. And that's the power of vicarious learning. So I hope that today there was maybe one or two things, just like reading a good book, that will stick with you and inspire you to make better choices than I certainly have in the past.
Well, Kris, I think I got 10 or 15 really good things like that I'm learning from your experiences. And certainly, again, check out that kriskrohn.com/podcast free book. We're just trying to flood the world with information to create some more financial geniuses out there.
All right, my friends, have it all. This has been Kris Krohn, Carson Tejan, wishing you the very best of life. Make the most of it today because you too can have it all.